Welcome everyone. Today we're going to practice some question from AAT Level 4, Statement of Financial Position for the Limited Company. So you're going to practice some question from the Sample Assessment 1 from the AAT website. So this is one of the important paper for our Level 4. And there are few questions that's really important to understand because in the exam, this type of question contain a lot of marks. So one of the question we can see here that is the cash flow statement and it gives us 32 marks. So it's very, very important we understand everything about the cash flow so that in the exam, even the question is not exactly same, but if our concept is clear, we'll be able to answer this question. So let's have a look. Obviously, in the exam, we're expecting different type of question. It's not going to be exactly same, but more we practice, it will start making more sense. So the best way you can score really good in the exam to practice more and more. So let's talk about the cash flow statement. Now, the cash flow statement is quite simple, and every single business they prepare cash flow statement. This cash flow statement is a part of the set of accounts. So when we prepare the accounts for a limited company, we have to prepare the cash flow as well, because this one is a part of the accounts. Now, the cash flow statement gives us the real picture of the movement of the cash. The reason we prepare cash flow, when company prepare the accounts, they prepare based on the accrual concept. And the accrual concept or the matching concept only consider the transaction that is relevant for this period. But the cash flow only consider is there any actual cash movement. So that means if we received any cash or if we paid any cash, we only consider that. So from the cash flow statement, the user of the financial statement will be able to know how much cash actually business received and how much cash actually the business paid. So let's have a look what we have here. In the exam, they will give us one profit and loss account, and they will give us the balance sheet, that is statement of financial position. And we have to use both of these to prepare the cash flow statement. And top of that, the question also provide some additional information. This one have to consider as well. So let's have a look what we have on the cash flow statement. The cash flow statement will be prepared based on IAS 7. IAS 7. So International Accounting Standard, that is IAS 7, will tell us how to prepare the cash flow statement. Now, the cash flow statement we can prepare by using two methods. The first method is the direct method, and the next one is indirect method. In the exam, we will be see the indirect method. So if you don't know the direct method, there is no problem for that. Even in the workplace, 99% company they use the indirect method, and some of the country the IS ban to use the direct method. So in the book you have some question how to prepare cash flow statement under the direct method, but if you don't know it, there is no problem for that, because in the exam they will not ask you to prepare the statement of cash flow by using the direct method. So if you know the indirect method, that is absolutely fine. Under the indirect method, we have three things that we have to know. The first thing we have to know, cash flow from operating activities. So cash flow from operating activities. Cash flow from operating activities. The next one we're going to see, that is cash flow from investing activities. Cash flow from investing activities. And finally, we're going to see cash flow from financing activities. Financing activities. So we have to complete all these three areas, and after that our cash flow statement will be completed. So we have to be very, very clear what entity or what items that are relevant to operating activities, which one is relevant to the investing activities, and which one is relevant to the financing activities. It's not very difficult, it's quite simple. The cash flow from operating activities is all about from the operation. So that is mainly linked to cash flow, that is mainly linked to the profit and loss account. For example, this is the profit from the operation. So anything from here, from the profit and loss account, that will be linked to profit from the operations. So cash flow from operating activities. So operating activities means a daily basis when business do the activity, buying and selling. So from there, whatever profit they make and how much is the finance cost, how much is the depreciation. So all of this thing you will consider under the cash flow from the operating activities. The next one is cash flow from the investing activities. This one is all about if we sell any non-current asset, or if we buy any non-current asset. So for example, if we sell any non-current asset, so cash will come into the business. If we buy any non-current asset, that will obviously the outflow for the business. So if I buy something, money has to go from the business. So all we have to consider for this cash flow question is money is going from the business or money coming in. So is it inflow or is it outflow? So if we understand that, our life will be very easy. If it is inflow, is it plus? If it is outflow, it is minus. So this is number one thing. Then if we have investment outside of the company, if we receive any dividend, then it will also come under the investing activities. For example, I can invest some money to another company and I'll receive the dividend for that. And finally, the cash flow from the financing activities. This one will mainly dealing for the share capital and the share premium. So if I issue any new share into the market, or if I raise any capital from the market, so money will come in. So for if this has happened, for example, last year my share capital was 200,000 and this year share capital is 300,000. That means I have raised 100,000 pound. So I'm going to record 1,000 pound, 100,000 pound as inflow. So if money into the business, I'm going to record on the financing activities. That's it. So profit and loss account linked to profit from operating activities. Then if I buy any non-current asset, if I sell any non-current asset, that's linked to the investing activities. And if I raise any capital through share capital or share premium, that's linked to financing activities. So let's try to solve this question and we'll see how it works. We try to explain as detailed as possible. Hopefully we'll understand very well after we finishing this question. So let's start to complete this question. So if we start reading this question, that will help us to understand what we have here. So you can see here it says, you have been asked to prepare the statement of cash flow and a statement of changes in equity for C Limited for the year ended 31st of December 2001. Okay. The most recent statement of profit and loss and a statement of financial position, the given with the comparative figure. So last year figure and this year figure of C Limited can be viewed by clicking on the button below. So this one is a profit and loss account. That's fine. So we have a revenue, we have a cost of sales, gross profit, profit from the disposal, distribution cost, admin cost, finance cost, tax. Now I want you to understand one thing. So the cash flow from operating activities, it is start from profit before tax. So you're going to start with the figure profit before tax. That means all of this thing is already gone from here. If I start from here, that means all of this thing we have the top is already deducted. Now we have to check every single thing that is linked to the operation. If something is not linked to the operation, we have to make that adjustment for that. For example, profit on profit on disposal of the property, plant, and equipment. So profit on disposal of property, plant, and equipment. So now this profit on disposal of PPE, that is property, plant, equipment, that means I have sold some property, plant, and equipment, and I have made a profit 139. Now the question is it my daily activities of the business? The answer is no. This is not the thing I do every day. For example, let's say I have a business and I have a 10 computer on the business. So my business is something. Now the computer I have on the business, I have it because I need it to run the office, to run the business. It doesn't mean I'm going to sell this computer because that's the computer I'm going to use to run my business. So selling the computer is not my business. So if I sell that computer because I need to buy the new one or for any reason, so the profit I'll make, this is not my daily business. So profit on disposal of the property, plant, equipment, that's not my business. So obviously this one I have to take away. I have to minus it. The reason this is not the profit I make from the operation. For example, let's say one business have a few land, and one particular year they sold that land and the profit become really high. So anyone who use the financial statement, they can say, oh, this business making a lot of profit. But the answer is no. Maybe next year they're not going to sell any land and the business have no profit at all, so the profit will be really low because this is not their business to selling the land. So anytime if the business sell any non-current asset and make a profit, this is not the profit from the daily operation. So for the cash flow statement purpose, we're going to take it out from the operational activities. Then the next one we have, that is finance cost. Now the finance cost means the interest. Finance cost means the interest. So if the business take a loan and they have to pay the interest. Now because of this interest, paying this interest, my profit figure going down, isn't it? So my profit before tax, 16,400. Now just imagine if we don't take any loan from the bank, so my profit will be 19,600, not 16,400, because I don't have any loan. So if I have any loan, then my profit is going down because of I have to pay the interest. So for that reason, this expense is not relevant to the business operation. It's not like a rent, it's not like a rate. So I have to add back this interest because I will say, no, even though I'm going to start with profit before tax, I'm going to add it back because it is not my daily expense. It is not the thing I do every day. Now, if I have a business and if my friend have a same business, and if we make the same profit, still maybe my profit will be lower because I took some loan from the bank and he didn't took any loan, so his profit will be higher. So this part, finance cost, is not linked to my operations. It's not my operational expense. So I have to put it back. So I'm going to add back. And finally, I have to check, is there any non-cash item I have? Non-cash item. Now the non-cash items means depreciation. Depreciation. Non-cash item means depreciation. So depreciation is the only non-cash item. Because of that, there is no actual movement of the cash. So because of the depreciation, no actual money going from the business or no actual money coming to the business. It's just on the paper because we prepare the financial statement based on the accrual concept. So depreciation is just on the paper. Every year we reduce the value of the non-current asset, but there is no actual movement of the cash. So for that reason, depreciation is just non-cash items. We have to add back this one. Because of the depreciation, there is no actual money going from the business. So all of this we're going to see from the operational activities. Let's move to the next one. The tax paid, this is of course our expense. So the tax is paid. Now the finance cost, we will add back with the profit from the operation. After that, we're going to take away as the interest paid. So we said, that's my interest, I have to pay it. That's my expense, so money is going because of that. So we'll record first, we'll add with the profit from the operation. After that, we'll minus it. So this one will have a two treatment. As a finance cost, I'm going to add back, but as interest paid, I'm going to take away. So Actually, this one have no impact on the cash flow statement because once I add it and take away, it will give me the same result, but we have to follow it. All right, we have some additional information. The depreciation is 4992. As we said, we have to add back. Depreciation is a non-cash item, so we have to add it back with the profit from the operation. Then property, plant, and equipment with a carrying value 543 was sold in the year. This is a little bit tricky because if we sold any non-current asset, that means our non-current asset going down. So we sold it this one, the carrying value. Carrying value means the book value, isn't it? After the depreciation. After the depreciation. So this is the carrying value sold, but we don't know how much we sold it for, but we can find it out. Because if 543 is my carrying value, and we can see we make a profit how much? 139. On the profit and loss account, we can see here we make a profit here 139. So if we make a profit 139, that means my selling price will be this plus this, isn't it? So if I added this two, that will give my selling price. Even though I don't know my selling price, but I know my carrying value and I make a profit 139. So that means I sold it for that. So if someone asks me, this pen is 10 pound, the cost. And if someone asks me, okay, how much you sold it for? And if I said I make a profit 2 pound, that means cost is 10 pound and I make a profit 2 pound. So I sold it for 12 pound. That's very simple. Then have a look what else we have here. Then we have revaluation for the land. So land was revalued upward during the year 7000. So when we're going to calculate the property, plant, and equipment, we have to revalue 7000 there. We are not considering this 30 because we have 30 on the top. That means we don't have to really consider this 30. The next point we have here, all sales and purchase were on credit. So every single sales we make and purchase we make credit. That means all my receivables, all my payables, they are on credit, and other expenses on cash. Then we have a dividend, 4,000 was paid during the year. This is the dividend we paid from our business. So this will come under the financing activities because the people who buy share from our company, we have to pay some dividend to them. So that is the expense for us. So that will come under the financing activities. If we receive dividend from any of the third party, we record it on the investing activities. Remember that. All right. So I think that's all. And we have one more thing, that is the current asset and the current liability, that is movement of the working capital. So try to understand that. It's a very important. Sometimes you might get confused for that. So we have inventories. We can see on 2010 my inventory was 18,608, and 2001 my inventory is 22,000. So it is increasing. If my inventory is increasing, that means I'm buying more inventory. If I buy more inventory, so money is going from the business, so it will be cash outflow. Remember that, don't be confused. If I buy more inventory, because 2010 my inventory was 18,000 and 2011 my inventory is 22,000, that means I purchased more inventory. If I buy more inventory, my warehouse have like more inventory now. So if I buy more, then I have to pay more. So I paid, so money is going, so it's cash outflow. The next one is trade receivable, same. So before that, I have a credit customer who's supposed to pay me 15,000. Now I can see it is 18,000. That means the receivables increasing. That means they didn't pay, rather they buy from me credit on credit more. So I sold it to them more, but I didn't receive any money. So again, it is a cash outflow. Cash outflow. And we have to see the same way the trade payable. So this one is very, very important. If it is decreasing, for example, the trade receivables, let's say last year it was 100 and this year it is 50. That means 50 pound I have received, because 50 pound people, they paid to me. So cash inflow. So if the receivables and the inventory is a decrease, that means cash inflow. If it is increased, then cash outflow. Remember that. All right, I think we discussed enough. So let's move on and start with the questions. Let's have a look. All right, so let's move on. We'll try to do it in the corner because we cannot write and we cannot see the question at the same time. So let's try to do it in the corner. So we start with the first 30 here, and we're going to write cash flow from operating activities. So cash flow from operating activities. Okay, so the first one we're going to start with profit before tax. Profit before tax. So the profit before tax figure, we have 16,400 from here. So 16,400. That's my profit before and tax. Then I'm going to do the adjustment now. All this thing that is not relevant to the operating activities or that is maybe non-cash, I'm going to now adjust it. The first one, I'm going to adjust depreciation. Depreciation is a non-cash item. So because of the depreciation, there is no actual cash movement of the money. So I have to put it back. So I'm going to say 4992. This is from the additional information. Then we have profit on disposal on PPE, isn't it? So we don't sell the non-current asset every day. So this profit is not from my business operation. This profit come from the selling of non-current assets. So this is not my really business, daily business. So I have to take it out because it's a profit. If it's a loss, I'm going to add that. So I'm going to say profit on PPE. So that is a 139, and I'm going to take away that. Then you have a finance cost, isn't it? This finance cost, we're going to add it back because this finance cost I'm only paying because I took some loan. So it's not my business expense. Maybe the other business, they don't have any loan and they don't have this expense. So that's the reason the finance cost we show separately in the profit and loss account. So we said finance cost. And that is how much here? 3,200. We're going to add that. Then we have, this is done. Then we have to do some working capital. So that is, we have discussed the inventories, payables, and the receivables, three things. So let's do that. So we have the first one, we have the inventories. Let's have a look at the inventories. The inventories, the last year it was 18, and this year it is 22, is increasing. So if I buy more inventory, money is going from my pocket, from my business. So it is cash outflow. So you have to find the difference. How much is the difference? So we said inventory. We say increase in inventory because it's increasing. Last year it was 18, this year is 22. So increasing in inventories. So the difference between these two, that is 4124, 4124, and that is minus because it is increasing. That means money is going. I have purchased more inventories, so money is going from me. Trade receivables, same thing, increase. Last year it was 15, this year 18. So people buy from me more. So no one paid. So it's actually outflow for me. So the difference is 3089. That's also outflow. If it is decreased, that means people pay to me, inflow. Then I'm going to see the trade payable. So let's have a look. The trade payable, this is our liability. So let's have a look. The trade payable, I can see it is increasing. That means I didn't make the payment. So I buy more services or product from my supplier, but I didn't make the payment. So that means the cash is not going, is the inflow for me. So I purchased more, but didn't make the payment. So I said, okay. So I said, increase trade payable. That's fine. So how much is it increasing? 2396. The difference that is increasing. So I'm not going to say it's minus because I didn't make the payment. If the trade payable is decreasing, that means I made the payment and money is going. So I didn't make the payment. I'm buying more. So it is basically inflow. It's not outflow for me. So the increase of the inventory and trade receivables is outflow. On the other hand, increase in the payable is basically inflow. Okay, so let's move on. So that's it from our cash from the operating activities. So I'm going to say added all of this minus the bracket sign. So that will give me 19,636. So 19,636. That is my cash from operation. So cash generated from operation. All right, now I have to do two adjustment. Remember the interest paid and the tax, these two things. That is I have to pay. So I have the one we said before, the finance cost. This is actually my interest. I have to pay this amount. So that will be the cash outflow. So first I will add it back to increase the profit. After that I minus it again. So I'll say interest paid, the same amount, 3,200. This time it will be minus. And the tax paid I have how much? The tax. Now, before I write the tax, like how much is the tax here? This is interest or tax. The tax might have a workings because on the financial statement, I need to see is there any tax. So I can see this year, the current year tax is 3546. So I'm going to write it down here. The tax 3546, that's for this year. But I need to see is there any tax from the last year that I didn't pay it. So I can see on my financial statement on the current liabilities, I can see I have some more tax liabilities. So the tax liabilities last year, it was 4120, and this year is still outstanding 3270. So I said, let me do some workings because at the beginning of the year, my tax liability was 4120. So I said balance BD, that is come from the last year, 4120, and this year I have 3546. So I'm going to add and minus, I still have tax liability 3270. So I said the balance CD, the closing balance is still 3270 that I still have to pay. So how much actually I paid? That's the question. So if I do that, let's find it out. How much is the figure? So 4120 plus 3546 minus 3270. So that gives me 4396. So I actually paid 4396. 4396. This is the amount I paid. So opening plus this year less the closing. So I said the tax I paid 4396. So that will be also minus this is the amount I paid. That's it. So if I have this figure, so I said net cash generated from operation or operating activities. So that is 12,040. All right. So the first part is done. Now I'll move to the next part. That will be the investing activities. Let's have a look what we buy as a non-current asset or did we sell any non-current asset. So let's have a look at that. So you can see here on the additional information. So we have one non-current asset that we sold, that is 543. So this one I sold. And how many asset we have? So this is the depreciation. I have to adjust the depreciation as well. And I can see at the beginning of the year, my property plant equipment was 31,962. At the closing is 77,736. Also have some revelation. So all of this I have to adjust. So let's do some workings first. So the workings for the PPE, property, plant, and equipment. So you're going to write it down here. PPE, property plant equipment. So at the beginning of the year, the opening balance, balance PD, we had 31,962. This is the one we had. After that, we have to take away the depreciation, because depreciation always reduce the value of the non-current asset. Current year depreciation 4992. Then we have to see is there any sold. So it's sold. We have a disposal of the non-current asset that the quotient tell us 543. And after that, we need to see is there any revaluation. So this is the revaluation of the land. We have 7,000. It will increase the value of the non-current asset. So anything that will decrease the value, that will come as a negative figure, as a minus figure. If anything that will increase the value of the non-current asset, that will come as a positive figure. So that's it. And we can see after that is still we have an asset. The closing asset is 77,736. So we said still we have this one. So the balance CD 77,736. This one also minus. So what happened at the beginning of the year, we have this asset, then we have depreciation in minus, we have a disposal, we sold it, so this asset is gone, revaluation is increased, and still we have this asset on our premises, on the business. So if I do all this calculation, that will tell us how much we have spent to buy the new asset. How much we have spent it to acquire the new property plant equipment. So that gives me 44,000, the difference 309. So this is the new asset we have new asset we have purchased during the year. And if we purchase the new asset, that means money is going from the business, so it's outflow. So I said that will be the outflow. So let me write it down. So cash flow from investing activities. Cash flow from investing activities. So we have this one, disposal of PPE, that is sold of PPE, and purchase of PPE. You can say acquisition as well, same thing. So purchase, we can see 43,309, 44,309, sorry, 44,309. And the disposal, you already know how much you dispose it. So 682, if you remember, the cost was 543, and we make a profit 139. That gives me 682, isn't it? I sold it for. That's it. Then if I adjust with this two figure, so that's my minus figure because I buy it minus going. So this one, we don't do anything. We'll leave this one as it is, or we can add, but for the time being, we'll leave as it is. So we have 682, and we have minus 44,309. So the difference gives me 43,627. Because we want to show how much is the money from the investing activities. So we said net cash from investing activities. So net cash from investing activities. So the first one was for the number one, it was for the operating activities. Number two, from the investing activities. And finally, we're going to do the financing activities. So you're going to say now financing activities. All right, let's have a look at that. On the financing activities, mainly we have a dividend paid, or if we have any bank loan, or the share capital. So we can see here, we have a share capital, share premium. Try to do it together because these two are same thing. So if we added these two and minus these two, so it will tell us how much is the increase. So adding these two and minusing this two will tell us how much the new capital came to the business. So if we find the difference, that will give us 13,070. Then we can see we have the dividend paid. So the question said during the year, we paid some dividend. So let's have a look how much it is. So the question said the dividend is 4,000. So you're going to write it down. 4,000 is the dividend. Dividend paid 4,000. And we have some bank loan. Now the bank loan is like kind of liability, but we have to see, is it money in or out? You don't have to see from the liability point of view. Here we're only looking at is money in or money out. So you can see the last year our bank loan was 18,000 and this year bank loan is 40,000. So we have borrowed more money from the bank. So if we borrowed more money from the bank, so more money came into the business. So how much extra money came? So it was 18, now 40. So that means 22,000 you borrowed more. So more money came to the business. So we said bank loan money in 22,000 plus. If it is opposite, for example, last year it was 40,000 and this year 18,000, that means we paid some loan. So that means it will be outflow, money is going. So that time it will be minus. But we've borrowed more money, so it is a plus. So you're only looking at these three now. So we have dividend paid is a minus. So this minus this plus this three, this gives me 13,000, 22,000 minus 4,000. This gives me 31,070. This is from the financing activities. So number 3, cash flow from financing activities. So we have done all of these three: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now we're going to do the final step, and this step will tell us my cash flow statement is correct or not. It's a very, very important part, so that after the cash flow we'll be able to see we have done it right or wrong. So let's have a look. So what we have here, three things. So number one, we have the cash flow from investing operating activities, then we have a cash flow from investing, then financing. So operating, investing, and financing. So what we will do, we have a number one, that is 12,040. 12,040. I'm writing here because we don't have a space there. And then cash flow from the investing activities, we have minus 43 627. So I'm going to write minus 43 627. And finally I have from the financing activities, that is plus 31,070. And if I do all of these three calculation, 1 2 3, that come from here, so this and this, so if I do the adjustment now, this plus this minus this, and this gives me minus 517, and this is minus, so we'll say decrease cash and cash equivalent. The reason we're writing both cash and cash equivalent, because cash is the real cash and the cash equivalent, that is equivalent to cash. For example, bank draft, check, all of this. After that, we'll check. So this is the minus figure we are in right now. So our cash position is now minus 517. So I want to check how much money we had at the beginning of the year. So I'm going to look at my financial statement on the bank. So cash and cash equivalent. Now I can see beginning of the year. So the money come from the last year. So opening balance, I had plus 372. So I said, okay, so 517 is a minus and plus 372. That means still I have a minus 145, isn't it? That's my closing cash and cash equivalent. And this one, beginning of the year, cash and cash equivalent. So this 145 exactly has to be match our bank closing balance. So let's have a look. If it is matched, then we have done right. If not, then we have done some mistake. So we come to the bank overdraft and we can see exactly the closing balance for the bank, 145 bank overdraft, and it is minus 145. That means it's a bank overdraft. So we understand our bank is reconciled and everything is matched. So after doing all of this, we can see this is the balance right now we have on the bank and it is completely matched. So you can see it is not very difficult, but it is tricky. So we have to do enough practice so that we can score 100% in the exam. But the first one will be the more tricky one, that is cash flow from operating activities. The investing activities and the financing activities will not be difficult, but there are few things that can give you stress in the exam. For example, that could be a three dividend. So one dividend that you paid, that will come under the financing activities. One dividend that you get from investing from the different company, that will come under the investing activities, but you minus from the operating activities. Then there could be a depreciation and disposal of the PPE. So there are some adjustments that could give you stress in the exam. So make sure you practice enough so that in the exam you don't like wait for that or you spend time on that. So more fast you can do exam, then it will save you time and you can complete the exam within the time duration. So hopefully you understand this question, and maybe for the next lesson we try to practice something else, and we're going to finish today. Hopefully that will be helpful for your exam. If you need any support from me, you have my email on the description. You can always email me. I'll try to help you from there. So try to practice. Hopefully we'll do more practice on the next lesson, and that will be very helpful for your exam. Thank you very much, everyone, for watching. We'll meet for the next lesson. Thank you.